Hi everyone. Studies of dividend investors reveal a striking pattern. Those who cross $10,000 in SCHD can retire years earlier than those who quit at $3,000. Same salary, same discipline, different threshold. I'm going to reveal the 3 specific breaking points that separate wealth builders from quitters, and the controversial truth about why high-yield ETFs paying 8% will destroy your retirement while SCHD's boring 3.7% makes you wealthy. This is the math Wall Street hopes dividend investors never figure out. With markets near all-time highs and inflation sticky at 2.8%, understanding which income strategy actually builds wealth has never been more critical. The first breaking point is $10,000. I call this the wake-up point. At SCHD's current 3.7% yield, $10,000 generates $370 annually. That's $31 every single month landing in your account without work. Suddenly, dividend investing stops being theoretical. You see it, you feel it, your brain registers, this is real money. And psychology shifts from, does this work? To, how do I scale this faster? More investors never reach this threshold because they quit at $2,000 or $3,000, earning maybe $8 to $10 monthly. At that level, it feels like a joke. They calculate how many decades it would take using linear math and walk away. What they don't understand is they're 12 to 18 months from the wake-up point where everything changes. But here's where most investors destroy themselves. When markets correct 25%, your $10,000 drop to $7,500. Weak investors sell and lock in permanent losses. Strong investors recognize discounted shares and buy more. During the last bear market, those who panic sold missed the entire recovery. Those who bought during the crash are sitting on massive unrealized gains, plus every distribution collected. This psychological test at the wake-up point determines your financial future. Pass it by buying more during fear, and you accelerate toward wealth. Fail it by selling, and you're back to zero. Now here's my controversial take that'll anger some people. High-yield ETFs paying 8 to 10% using covered call strategies are traps for uninformed investors. They're buying today's income at tomorrow's expense. Those yields come from selling upside potential and often include return of capital, not actual earnings growth. SCHD's boring 3.7% yield that grows at approximately 11% to 13% annually will absolutely crush them over 2 decades. Yield chasing destroys wealth. Dividend growth creates it. I've watched investors chase 10% yields, celebrate their monthly distributions, then watch their principal erode year after year. Meanwhile, SCHD investors with lower starting yields build portfolios that grow in both distribution income and capital value. 20 years later, it's not even close. Here's what makes SCHD's structure exponential. The fund systematically grows distributions at approximately 11% to 13% annually. This creates yield on cost expansion nobody calculates correctly. Buy today at 3.7% yield, hold for 8 years while distributions grow at 12% annually. And your yield on cost approaches 9.2%. Another decade, your yield on cost exceeds 20%. Every $10,000 you deployed years ago now produces over $2,000 annually in passive income that keeps expanding. You're collecting distributions that grow faster than inflation, faster than cost of living increases, and often faster than salary raises. Your passive income stream accelerates. The second breaking point is $100,000. I call this the crossover. At this level, SCHD produces $3,700 annually. That's $310 every single month. You've reached the crossover point where your invested capital contributes as much to growth as your own monthly contributions. Your money is working a full-time job alongside you. Set distributions to automatic reinvestment and you're adding shares through 2 engines simultaneously. Your paycheck plus your growing distribution stream. This is the threshold where investors stop feeling like they're pushing a boulder uphill. The boulder starts rolling on its own because distributions grow at approximately 12% annually while you're also adding shares through reinvestment. You're compounding on 2 fronts at once. A $10,000 position established a decade ago generates triple the distributions today. Over 20 years, the initial stake pays nearly 10 times the original rate. This is why informed SCHD investors achieve financial independence substantially faster than peers earning identical salaries. The investor earning $75,000 annually who crosses the crossover at the age of 45 can retire at 55. Their neighbor earning $75,000 who never builds invested capital works until 67. Same income, completely different outcomes. Critical warning for anyone within a decade of retirement. SCHD is not a bond substitute. During severe corrections, this fund can drop 30% in weeks. If you're 62 with your entire nest egg in SCHD and need liquidity, you'll be forced to sell at the worst moment. The solution isn't avoiding SCHD, it's proper position sizing. Age 35 to 45, go aggressive. 60% SCHD, 30% VTI, 10% bonds. Age 45 to 55, shift to 50% SCHD, 30% VTI, 20% bonds. Age 55 to 65, move defensive at 40% SCHD, 30% VTI, 30% bonds. Here's what drives me insane. Investors buy 15 different income funds, create massive overlap, pay multiple expense ratios, and confuse themselves tracking everything. SCHD holds 100 quality companies selected for distribution consistency and fundamental strength. The index self-cleans, companies cutting payments get removed automatically. You don't pick stocks, you don't monitor earnings. You buy SCHD, enable automatic reinvestment, and let mathematics compound. Simplicity wins, complexity loses. The tax structure gets completely overlooked. SCHD distributions qualify for preferential treatment. For most investors, that's 15% rather than ordinary income rates of 22 to 24% over 3 decades. This compounds significantly. Hold SCHD in a Roth IRA. Those distributions compound completely tax-free permanently. You're building a perpetual passive income machine operating outside the tax system. While your neighbors pay 24% on bond interest, you're paying 15% on SCHD distributions. That's 9% difference compounded over 30 years, separating comfortable retirement from wealthy retirement. Getting to the wake-up point is genuinely difficult. Saving $500 monthly takes 20 months of sacrifice. You're skipping vacations. You're driving a paid-off car. Packing lunches. For the first 18 months, your annual distributions are maybe $250 total. It feels pointless. This is where 4 out of 5 investors quit. They calculate using linear math and conclude it's impossible. They're wrong because they don't understand the exponential curve that's just beginning. The third breaking point is $300,000. I call this the freedom line. At current rates, this produces $11,100 annually. But because distributions grow at approximately 12% yearly, in a decade that same capital generates over $34,000 annually. In 20 years, over $103,000 per year in passive income from that original $300,000, all while principal continues appreciating. This is where investors transition from building wealth to wealth is building itself. At the freedom line, you're not working for money anymore. Money is working for you. Your SCHD position generates enough income that even without adding another dollar, it will continue growing and eventually produce more annual income than most people earn from their jobs. The execution is simple, but demands discipline most investors lack. Buy SCHD consistently regardless of market conditions. Enable automatic distribution reinvestment. When markets crash and SCHD drops 25%, recognize it as discounted shares. Investors who bought during the last major sell-off are now sitting on substantial unrealized gains, plus all distributions collected. The difference between investors who build wealth and those who don't isn't intelligence, luck, or income level. It's the ability to keep buying when everyone else is selling. It's the discipline to cross the wake-up point, push through to the crossover, and eventually reach the freedom line. If you want to know which growth-focused income funds pair perfectly with SCHD without creating redundant positions, I break down exact combinations in my next video. These are mathematically optimized allocations designed for maximum distribution, growth with minimum correlation. Hit subscribe, and let's build real wealth through systematic income investing. Disclaimer: this content is educational, not financial advice. All investment carries risk, including potential loss of principal. Consult a qualified professional before making decisions. This is Invest ED, building wealth the boring way that actually works. Smash that like button and subscribe for strategies Wall Street won't tell you. Smart investing, profitable results.